Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, welcome back to the Money and Meaning Show. My name is Jeff Bernier. I'm your guide and host today, and so happy that you decided to spend a few minutes with me today. One of the things I love most about the work we do at our firm, TandemGrowth, is that it sits at the intersection of evidence and behavior. Good investment outcomes are never just about what markets do. They're also about how we actually respond to what markets do. And part of how I stay grounded in this work is through regular conversations with mentors and guides that I deeply respect. One of those people is my friend Larry Swedroe. Every couple of weeks, Larry and I get on a call and talk about market history, portfolio construction, factor research, and most importantly, how to help real families navigate uncertainty with confidence. Recently, Larry shared a concept with me he's been teaching for years, something he calls the self-healing mechanism of markets. About the same time we were having this call, 2 articles came into my inbox that fit perfectly with this theme that I'd like to share a little bit with you today about. The first one was a piece by Wiggins called A Decision a Day, which describes the behavioral traps modern investors face today. The second piece was from Zweig at the Wall Street Journal that he called Capital Sins, which highlights how recency bias and the fad of the day can quietly push investors into dangerously concentrated positions. So in today's episode, we're going to weave all these together in one big theme: how markets heal, how investors overreact, and how broad diversification and a bucket approach can help protect us from ourselves. You know, this might be one of the most important conversations we've had in a while, so let's jump right in. First of all, let's talk about Wiggins' article, A Decision a Day. You know, he asked a simple question that's really profound, and that's, what does a difficult decision look like? What does a difficult decision look like? And he believes a difficult decision is one where there's lots of moving parts, new information is hitting us constantly, emotions are heightened, and nothing stops us from reacting too quickly. And of course, that's the exact market that we face as investors in the investment environment. So every time we check our portfolio or see a headline or glance at a red number on a screen or hear a pundit predicting what's next, we create a brand new decision point. Do I need to do something? And to make matters worse, our decisions aren't just shaped by financial information. They're also shaped by unrelated things, like how stressful our day has been, or did I get adequate sleep last night, or do I have the fear of missing out, or just plain boredom. And thanks to modern technology, reacting can be instant. So we read the scary headline, we check our account, and boom, we can hit the sell button, all in less than a minute. And this can be obviously very damaging to our long-term plan. So Wiggins argues that successful investors must make decisions that are, number one, consistent, which basically means it's anchored to a process. Okay, so your decisions are anchored to a process, so they're consistent. Number two, they're slow. They're never made while emotional. And number three, they should be infrequent. Doing nothing should be the default if you have a good process. But everything around us pushes us in the opposite direction. And that's exactly where the setup for understanding Larry Swedroe's self-healing mechanism of markets can be helpful. You know, this construct of understanding how markets self-heal can be really helpful in this context, and we get all this information. So Larry describes bear markets as having 2 primary ingredients. One is falling earnings, and the second one is falling valuations. Now, when valuations fall in stocks, as an example, then the risk premium actually goes up, meaning you should expect to be paid more for taking the risk. But again, to summarize, Larry believes bear markets have these 2 characteristics generally: falling earnings and falling valuations. And the combination creates dramatic declines that we experience during recessions or wars or market panics or whatever the actual cause of the bear market is. But here's the part that most investors miss. When valuations fall, all things being equal, expected returns rise. Let me say that again. It's basically an inverse relationship. When valuations fall, all things being equal, expected returns rise. So for instance, a stock that's trading at 20 times earnings that drops to 10 times earnings hasn't just declined, but its earnings yield has doubled from 5% to 10%. Falling prices, again, all things equal, equals higher expected returns. That's self-healing. And the history of market confirms this over and over and over again. All you have to do is look at market history. There are 3 really long periods of time where U.S. stocks underperformed treasury bills, riskless treasury bills. 1929 through 43, 1966 through 1983, and 2000 through 2012. So these were 3 pretty long periods where stocks underperformed cash. And all 3 of these were followed by strong decade or 2 of above average stock returns. So each of these periods of lower realized returns were followed by decades of much higher excess returns. Why? Because those painful periods pushed valuations down, and low valuations set the stage for the recovery. But investors rarely capture the recovery because they give up near the bottom, right when the healing starts. And that's not just true for stocks. This self-healing happens across many asset classes or investment categories. And in my call with Larry, he went through several with me. For instance, value stocks versus growth stocks. In the late 1990s, large growth stocks soared. You probably remember it. Small value trailed by almost 13% per year. And investors declared value is dead. And the valuation spreads blew out to historic levels. In other words, the price of growth versus value blew out to really high valuation spread, which means expected returns for value quietly skyrocketed. So over the next 8 years following this, small value outperformed large growth by over 14% per year. Not because anybody predicted it, but because valuations normalized. In other words, markets healed. You can see the same thing with corporate credit or corporate bonds. In a credit crisis, more bonds default, so defaults rise, fear spikes, lenders tighten underwriting standards, so they're more careful about lending the money, and credit spreads widen dramatically. Spreads widen might jump from 3 to 7%. So in other words, that's the extra return you get for taking credit risk, in other words, investing in businesses versus investing in government bonds. So default rise, fear spikes, underwriting standards tighten, and again, you get a much higher yield for being in these credit bonds or corporate bonds as opposed to government bonds. And when these spreads widen, again, it's just like the valuation of stocks. When the spreads widen, you get higher expected returns on the bonds. And the tighter underwriting actually means you have less risk. So you get higher yields and less risk. In other words, the pain reset the market, terms improved, and expected returns rise. That's self-healing in the bond market, in the credit markets. You see the same thing in private credit. In periods of economic stress, covenants tighten. In other words, the lending covenants for the lender tighten to the borrower. Loan to valuation ratios drop, which reduces risk. Sponsors who are borrowing the money have to contribute more equity. And then finally, lenders demand higher interest rates. So today, as an example, broad private credit indices are yielding around 12%, and you actually get more protection than you had before. So once again, bad times, better terms, higher expected returns. Again, another example he used was reinsurance. After major wildfires or hurricanes, what happens? Premiums jump. The reinsurers charge higher premiums. Deductibles rise, which reduces the risk to the insurance company. Underwriting standards tighten. Weaker properties are excluded from the risk pool. And again, after these bad times, expected returns skyrocket. And Larry shared the reinsurance fund he follows as an example. It lost money for 4 of 6 years during some difficult underwriting periods and saw assets fall dramatically as investors fled. And then after the investors fled, the portfolio earned over 45% last year. And almost no investor was there to enjoy the recovery. So that's self-healing in its purest form. So the lesson from that section with Larry is the self-healing is a universal feature of risk assets. All risk assets grow through periods of difficult times, but there's a self-healing mechanism because of prices and expected returns. And this pain lowers the prices, which increases expected returns, but only for the disciplined investors who capture the healing. And undisciplined investors, they often fall prey to recency bias, which brings me to the Jason Zweig article that he called Capital Sins. And I'm extrapolating a little bit here, but I'm using it as kind of a warning about the fad of the day. So Jason Zweig recently wrote a brilliant column in the Wall Street Journal called Capital Sins. And he pointed out that the large technology giants, Apple, Microsoft, NVIDIA, Alphabet, Meta, Amazon, they've delivered extraordinary returns in large part because the returns on investment capital has been incredible. Just over the last 5 years, this is a 5-year average. Apple's return on investment capital has averaged 60% a year. NVIDIA's 48%. Microsoft, 29%. Alphabet, Meta, in the mid-20s. And Amazon, around 11%. I mean, these numbers are breathtaking. And they explain why investors have come to believe that these companies are unstoppable. Just buy them and don't worry about it. But Zweig in the article highlights something quite remarkable. And that's that the world has changed a bit. AI, which all these companies are investing heavily in, is not capital light. It's capital intensive on a scale we've never seen before. Big tech is expected to spend over $3 trillion on AI between now and 2028, but it only has cash flow to cover about half of that. So according to his research, to bridge this gap, these companies have issued more bonds in the last 10 weeks this fall than in the previous 3 years combined to raise the capital to make these huge capital intensives. So these companies that investors love because they were very capital efficient, they didn't require a lot of capital to grow the earnings, are suddenly drowning in capital expenditures. They're having to invest in capital intensive infrastructure like data centers and electric power generation and all those kind of things. So as Zweig puts it, AI had better be even more lucrative than the tech giants are projecting, or investors are going to be saddled with excess capital and unsustainable valuations. So again, I'm extrapolating this a bit to talk about recency bias in real time because these stocks have done incredibly well. And recent winners are assumed to be the permanent winners. Investors pile into the fad of the day, the story gets more extreme, valuations stretch, and expectations become more unrealistic. So this is the opposite of self-healing. This is self-inflating. And it's a reminder of why we avoid concentration. And so let's talk about concentration and the dangers of concentration. Concentration can take many forms. Owning one stock, owning one theme, owning one story, or even owning one asset class. And it happens frequently, very subtly, especially when a category performs so well for such a long period of time. And one of the most dangerous forms of concentration is going all cash. So liquidating a broadly diversified portfolio and going all cash is concentration. So when people say I'm moving to cash until things make more sense, what they're really saying is I'm making a massive bet that inflation stays low, that markets won't recover while I'm out, and I know exactly the right moment to get back in. Well, that's not caution. That's a bet. That's a bet on one idea. The lack of diversification is what this is. And it's a bet most investors lose on, which brings us to the solutions. The first one won't be a surprise to you because I talk about it here a lot, and that's broad diversification is the antidote. Broad diversification recognizes we don't know which asset class will shine next. We don't know which story will disappoint or surprise on the upside. And we don't want to build a plan that depends on being precisely right about a concentrated bet. So instead of betting on one idea, we own many ideas across regions, across styles, across factors, across asset classes, across public markets and private markets, and across uncorrelated sources of return, like reinsurance or infrastructure or alternative premiums. Something in the mix is generally always healing, and something is always resetting. Something is always moving from fear to opportunity. We just don't know which when. So broad diversification lets the healing process work even when one part of the portfolio is hurting. The final antidote or helpful tool, I believe, is sort of the bucket approach that we use in our firm, TandemGrowth. And it's not really a portfolio tool. It's more of a behavioral tool. And so it really consists generally of a mental construct of 3 buckets of capital. So bucket number 1 would be what I would define as your emergency reserve capital. This is cash in short-term, safe, liquid assets, so clients can never be forced to sell at the wrong time for short-term emergencies. Number 2, your short-term portfolio. These are generally assets that are held in low volatility assets that are set aside for withdrawals, distributions that you expect to take from your capital over the next couple of few years. And this dramatically reduces what we call secrets of return risk because we have enough capital to let the healing occur in bucket number 3, which is the long-term portfolio. And this is where the growth happens. This is where the healing occurs. And this is where markets can recover if you're patient. And the 2 buckets help you do that. So the buckets are designed to help us reduce the noise, reduce the panic, reduce these decision points that Joe Wiggins wrote about, reduce temptations, and allow the long-term engine to keep running even when emotions can be running very, very high. So the bucket approach is an antidote to this decision a day mindset when you're getting all these inputs every single day. So it turns emotional markets into manageable markets. And that's the key. So let me pull all this together. I know I've covered 3 or 4 big ideas here. So Joe Wiggins warns us that modern investing environment tempts us into constant decisions, fast, frequent, and emotional decisions. Larry Swedroe teaches us that markets often heal themselves precisely when investors feel most discouraged, but only if we remain invested. Jason Zweig reminded us that recency bias and the fad of the day can lead to dangerous concentration, even in the strongest companies. And of course, our work at TandemGrowth is designed to help clients avoid these traps through broad diversification, thoughtful rebalancing, evidence-based decision-making, and the bucket approach that gives investors the time and emotional confidence to let markets heal. So successful investing isn't about the next move. It's about making decisions that are consistent, slow, infrequent, and grounded in evidence, and most of all, humility. Just so much we can't and don't know. That's how you protect your wealth. That's how you stay invested long enough to benefit from the self-healing markets. And that's how you grow both your money and your meaning. Thanks for joining me today. I hope you found this helpful. Please check out past episodes of the Money and Meaning Show wherever you stream your podcast. Give it a listen, pass it on to friends, give us a rating. We'd love to hear from you. If you'd like to reach out to me, you can email me at moneyandmeaning@tandemgrowth.com. And of course, you can learn more about me and our firm at TandemGrowth.com. Thanks again for joining today. Hope you have a great one. Be well.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, Feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at TandemGrowth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of TandemGrowth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, TandemGrowth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. TandemGrowth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.